folks, hope you're all well and welcome back to what will be the final video in the risk management education series. It's been a few weeks since I put out the last video, just because I had a bit of time off over Christmas and New Year, and then the start to 2023 has been a bit busier than anticipated, so I've not been able to get this series finished. But hopefully moving forward I'll have a bit more time to put some content out, and certainly we'll finish this series today. We've covered the main content in the series already in the videos in 2022, and the final two items that I had on the agenda are fairly small, so given we've had that break, I've decided just to put them together in one video rather than split them over two. And if you've not watched those previous sessions, I'll link them on screen, and I'd recommend going back to watch them just so you can get a holistic view of what is my view of risk management and how I apply risk management to my own day-to-day and week-to-week. So today then we're going to talk about leverage, and I'll offer my view on responsible usage of leverage and how to properly risk manage it in order not to blow your account or get wrecked or suffer too deep a drawdown. We'll talk about how, certainly in my experience, most of the retail community and particularly in crypto use leverage and the dangers of it and how you can hopefully avoid these. We're also going to talk a bit about how you manage in-flight trades, so once you've done your trade planning and you've got your overall risk parameters set out, how do you manage that trade once it's in flight and potentially turn some losers into either small winners or smaller losers, just to kind of complete that holistic view, as I say, of risk management and complete the series. So the goals for the session today then are fairly straightforward, and that's to understand responsible uses of leverage and how I apply the learning that we've gone through so far in order not to be a degen with leverage, and managing risk when in trade and how that links back to optimization of your rules-based strategies that we've spoken about before, and how you can identify things that happen over and over again within the trade and use those as a kind of rule set after the trade's in flight to pull the ripcord if you need to when a trade looks as if it's going against you. First slide then, responsible leverage, how not to be a degen. And I've obviously been a wee bit humorous there in terms of using that degen word, but in some markets, particularly cryptocurrency, as I've mentioned a few times, the joke is maybe a wee bit too close to the bone for some, and it is maybe a wee bit more normalised than it would be elsewhere. So I've mentioned already in this series, but I want to reiterate it again right out of the gate here, that the thing you should always have in your mind when using or considering the use of leverage is who stands to benefit from it. And it's something that I wrote in an article last year as well that I'll put on screen just so you can see it. But the leverage casinos who offer huge capital multipliers are not doing that out of the kindness of their hearts because they want to see us all succeed. They're far from a great bunch of lads. They offer those multipliers because they know it's tempting to ill-disciplined gamblers looking for that one big win to set them up. We've spoken a lot in this series about not chasing that one big win, not taking too much risk in order to see one big win, and that's where your equity curve growth over time comes from. We've spoken a lot about the series of trades and controlling risk across the 100 or 200 or 300 series of trades and seeing your equity curve grow naturally that way through good risk management and good rules-based strategies. As with all gambling, and certainly that type of gambling, the house always wins in the end. And across the series of trades, if you were to look at all traders or gamblers, as we'll call them here, who recklessly use leverage, the exchanges and the brokerages make a huge amount of money for them, both in terms of the trading fees once the leverage is used, because you obviously pay your trading fees on the size of the position. So if you're leveraging up 100x, you're paying 100 times the capital trading fees that you've got. And in terms of people taking too much risk and being liquidated and losing their account in that way. So if you're someone who's successful with high leverage and you've got a rules-based system and you can control it, it's tested and you're managing risk appropriately within that, then congratulations. And I'm in no way trying to talk down you or your achievements, but I would say if you do fall into that category, then you should understand that you're in the minority, and that's why exchanges and brokers offer the leverage like that they offer leverage. It makes them money, not the majority of participants. So with that said, leverage at its core carries a risk to your entire account. For those of you who maybe not used leverage before or don't really know how it works. If you use cross leverage, which a lot of brokerages and exchanges will default to, and in fact there are some that I use, the cross leverage is the only option on the table. They don't allow you to isolate your margin or isolate your leverage. You get a liquidation price whenever you place a trade or a leverage trade. You basically borrow to long or short. You're borrowing funds to long, and you'll be given a liquidation price that if it goes above or below, depending on the direction, you lose your account on a cross margin. And I've been involved in many communities and Discord communities or other communities within the trading space where that liquidation price is discussed as if it were a factor in the risk or the risk management of a position. Traders who are essentially, I'm going to go 20x or 30x and my liquidation price is X, so the price will never go there. I don't think it's going to go there, so my position's fine. And ultimately my view on this is that if you use liquidation price at all, if you even have to look at it on cross margin, then it means you're risking 100% of your account on that trade. And if you think of the mindset that I've discussed there in terms of trader X places a long order, they're going long with a buy price of 10, they're using 50x, the liquidation price they're given, either calculating before or once they've entered, is 5. They look at the technicals and don't think it's ever going to go to 5, so don't do any other risk management than that and just enter the trade. That's reckless, because none of us know what the market's going to do. There's always occasions where we see big spikes one way or the other. Even if it's unlikely that it's going to go that low, you're still taking the risk with 100% of your account. And I have been involved, as I say, I mentioned this I think already in the series, with somebody who lost a 6-figure account of their own capital that they'd built up by not having a risk manager stop loss in place for a leveraged position that would control their stop out or control their risk far before the liquidation price was ever met. So in my view, that liquidation price is irrelevant, and certainly the way that I use leverage, the liquidation price is irrelevant, because my stop order is going to be so far before that I never need to worry about it. And I'm not going to talk about scenarios where markets move really quickly and stops get skipped, because that's a technical issue that there's not really very much that we can do about in that scenario. But 99% of the time, particularly if you're a short term or an intraday trader, that's not the case. You're still talking about really small moves on an intraday level, really small moves with leverage, where your stop generally always gets filled. These black swan events or huge whole market events, taking crypto as an example again, are rare. That's 1% of the time if you're lucky. So we're not going to concentrate on stops being skipped and technical issues. That's something else. But ultimately, that liquidation price, as I said, you shouldn't be relying on that. You should never rely on that. Everything should be risk controlled in the same way that we've spoken about so far. So in terms of then, what do I consider responsible usage of leverage? So as we covered in the position sizing session, the first and my main use of leverage is to size up intraday trades to the maximum allowable account risk. So I'll go over the example again so you can see it, but if I have a max account risk of 2%, which is a reasonable max account risk, and on an intraday trade, let's say I'm on a 5 or a 15 minute chart, and the entry that I'm looking at versus the stop that I think is right technically is only a 0.5% risk within that trade, then I can use leverage at 4x in that case, because the 4x would then multiply that 0.5% risk up to 2% risk, and I can go in my full account, or a position size of my full account, 4x to give me that 2% risk. And even if I get stopped out, although I'm in my full account, I'm still only losing the 2%. That's my maximum allowable risk. And the reason I would use it that way is, again, we spoke about it, it keeps my positions consistent across the series of trades. So if you're looking at a strategy and you've done your maths where it's a 1 to 2 minimum risk reward, and you can be successful 50% of the time, then you're going to make money in that strategy. But if you're making different amounts in terms of the profit factor within each trade, so if it's 0.5 at 2 to 1 in one trade, and 0.7 at 2 to 1 in another trade, and 0.8 at 2 to 1 in another trade, then your risk is actually moving there. It's still within your risk appetite because it's still below your 2%, but it's not consistent. So the way that I look at it is I want to make sure that all of my trades are exactly the same in terms of the maths of the sizing, so that every loss and every win brings back or loses the same amount. It's always the same amount of account, and that's how then you grow the equity over time. So that's the first use of, or responsible use of leverage in my opinion. And the second is if you're using a smaller account and you want to spread that capital over multiple trades. So if you've got a risk management strategy and part of your plan is that you're allowed to have 4 open trades at any given time, or if it's 2%, you're allowed 8% maximum market exposure at any given time, which then obviously equates to 4 trades. If you're on a small account and you're trading intraday, for example, where the risk within the individual trades is going to be small, so small that you would be in each trade with your full account. If each trade using leverage can then be leveraged up to 2% and you use less of your capital, you can use that to spread it further across the market. Now that's a scenario that's less likely for me personally, because I have a very small target on a weekly and monthly basis, and I'm quite happy being in one trade at a time and managing one trade at a time. I do allow myself to go into more than one at a time, but I never really find any requirements to be in more than one at any given time. But this would be a method that I would use if I was wanting to do that and I didn't want to use all the capital on a small account at any given time. I would use the leverage to essentially give myself the flexibility within my 2% risk and my 8% market risk or market exposure to take more trades. And that's it. That's the only two, in my opinion, responsible uses of leverage within trading. And there are many other uses that people implement within their own strategies at the moment. I've listed a few of them there, but things like randomly picking an X, and I'm sure we all know traders who have gone into trade positions and it's an arbitrary, I'm just going 10x, 10's a nice round number, so I'm going to go 10x, or I'm going to go 20x because it's a nice round number, or I'm going to go 50x because it's a nice round number, without any kind of sizing done behind that. Now I'll caveat that by saying there are different ways to manage your risk within leverage positions. So I know of some traders, some very good traders, who reduce their account size but will still use 50x because they see the outcome at the end of that as being risk managed, if you see what I mean. So let's say you've got a $1,000 account, just out of interest and easy numbers, and you take $50 out of that and set it aside in a separate account, and that actually becomes your leverage trading account. If you go 10x on that $50, then it's actually still only 5% of your account times the 50x, but you've still got your stop in place within there to stop you at 2. You can work out the numbers so that taking smaller chunks of your account, and that kind of falls into the bracket of spreading a smaller account across multiple trades, just a different way of doing it than I would do. So what I'm talking about in terms of that randomly picking an X is not having your account filtered at all, just using your full account and going into a trade, and I'm going at 50x and my liquidation price is there and I'll be fine, and if it hits liquidation I'll lose my whole account. That's what I mean when I talk about the irresponsible uses. Pretty much anything that takes you outside your risk management parameters, I would say, is I'm obviously going to say that's irresponsible. So if you've got a risk management plan and you've defined what your risk appetite is, where you want to control your risk within the market, if you do anything that goes outside of that and that involves leverage, it's obviously not a responsible use of it at that point in time. And the other one that I put on there, just that I wanted to call out, is that there's many more uses than this that people would use that I would consider or not consider for myself. But the last one that I put on there just to talk through is I think a lot of people are driven when they go into leverage, particularly at first, by what picking a certain X means for profit rather than working out what that actually means for risk. And I think, as I've said a few times in this series, and hopefully it's come across, profit is an outcome of your process. It's not the driver of any decision making for going into trades. So you don't go into a trade thinking I'm going to go into that trade because I can make $500 profit, and that's your decision point. It just doesn't make any sense. You'll have a technical reason for getting into that trade. You'll have your rules-based strategy. You'll have looked at your entry patterns. You'll know why you're getting into a trade, and you'll follow those rules. That's the controlled way to do it. And then you'll have a system for deciding how much risk is involved in a leverage trade, and whether that's within your risk appetite, and you can pick your leverage based on the risk rather than on the profit. So that's what I was describing before when I talked about sizing up intraday trades to max allowable risk, and how I select my leverage multiplier based on maximising my allowable risk within trades as per my risk appetite within my risk plan. So look at risk first, always look at risk first, and then profit is an outcome of your process, never the deciding factor on anything. So that kind of covers the leverage bit. I put it at the bottom of the slide there just to drive home the point again. Liquidation price should be irrelevant. If you're in a conversation with people talking about leverage and talking about liquidation prices, it's probably not the right framing of the trade that you should be getting at. It's not a stop loss. A liquidation price is not a stop loss. That's you essentially risking 100% of your account on any given trade, and I think we've discussed that to death in the initial videos in the series, so we'll not go over again why risking 100% of your account on a single trade is bad. So that's my view on leverage, and I'm going to give the example just quickly again of the sizing up example, the slide that I gave in the previous video. So this is, again, it's just a fictional account, showing how you would do the maths on this. So fictional account's $10,000, max account risk per trade 2%, so which makes your max trade risk in terms of dollars, the 10,000 times 2%, so $200. This particular trade had an entry of 19,299.5, stop 19,153.5, so that's a 0.76% trade risk. The risk premium per unit, so your entry minus your stop, because this is a long, was $146. So the position size becomes 200 divided by 146, so your maximum risk divided by the risk premium per unit, so 1.36 units. 1.36 units at the entry price at 19,299.5 is a position size of $26,247, so 262.4% of the available capital that we've got. So we can see their leverage is required in terms of sizing that up, and the leverage calculation is simply the total position size in dollars divided by your account, so 2.62x, and that would give a full size trade at 2% account risk with an individual trade risk of 0.76%, and with an RR of 2.16 you would return 4.32% account on that trade where it's successful, which it was obviously in this example. Now, I spoke about this in the position sizing session, but I'll mention it again as well. When you're factoring in your risk and your leverage, a lot of people forget to factor in the fees. So when you pay fees on positions, the fees calculated based on the dollar size of the position, both your entry and your exit fee, whether that be an exit for profit or an exit for stop loss, and depending on how you've got your order set up on exchanges, that'll either be market, which will be a wee bit more expensive for you, or limit orders. I try to limit in and limit out for profit, but for stops you haven't really got much option but to market, because you just want to get out as quickly as you can. So on leverage positions, because the dollar size is much larger, your fees are much larger as well, and you'll find particularly on smaller accounts, if you're someone who's trying to build a smaller account, that the leverage fees, when you're position sizing properly and when you're managing risk properly, can often take huge chunks out of your profit, and they can often, on stop outs, add massive amounts to your actual account loss on stop. So if you were to position size fully just using this maths but not take account of fees, you may find on smaller accounts that your loss is actually 4% of account as opposed to 2% of account, because of the amount that the fees added on top of that. And similarly, you may think you're in a 1 to 2.5 trade, but when you factor in the fees, it actually only becomes a 1 to 1.4, which would be below your filter for filtering out trades as part of your trading plan. So I would always recommend calculating the leverage with the fees in mind. The simple ways you can do this, you could just take half an X off, and that half an X covers the fees and covers the risk. That's a fairly arbitrary way of doing it, but it would for the most part get the job done. Or you can have a position size calculator that works your position size out based on the fees. Now, I have got one of my own that I've written on my website, and that's the option that I take in terms of that, so that it's sizing again the same way every time. But it's what's right for me is not going to be right for everybody. So just keep the fees in mind when you're using leverage, and keep in mind that they can be quite significant, particularly when you get over the larger numbers. You go over 10x on leverage, your fees are going to get quite hefty, and if you're using 100x on leverage, they're going to get properly hefty. So bear that in mind. The last little topic I want to cover quickly in this session is in-trade risk management, or how you manage in-flight trades, essentially. Once you've done your planning, so everything we've spoken about so far is about the planning of the trades. You've got your rules for identifying when the trades are valid. You've got your risk plans for identifying how you do your position size and how much account risk you're going to risk on each individual trade. Based on your technical analysis and those plans and those rules, that you're going to take your entry at a certain point, take your stop at a certain point, target at a certain point, work out your RR and so forth. And it can be a case of just saying that you're going to run on those and those alone, and either you'll let the trades hit target or you'll let the trades stop out. But as you get a wee bit more experienced within particularly intraday trades, you'll start to identify certain things that happen over and over again and give you kind of early warning that potentially the trade isn't going to go any further in your direction. It's not going to reach for the target you had initially set out for T1, and you might want to either pull the ripcord there and take whatever profits you've got on the table, or move your stop up to protect the position, and so forth. And these can help in terms of refining your strategy going forward. So you'll have a set of criteria or a set of rules that you want to see in order to enter the trade. So that's your rules-based strategy, as I've spoken about before. But you may also find that there are things that are true when you're in trade. So they could be simple or complex, however you want to look at them. But something as simple as, for example, if you use EMAs, now I don't use EMAs, but if you use EMAs and you've entered a trade and it's a long trade and price is above the 21 EMA, for example, you might say that one of your conditions is that you need price to continue to close above the 21 in order for the trade to stay valid. And you may notice in your back testing that when you get one or two closes below the 21, that signals the end of the trend, the end of the impulse, and you're likely to get a pullback from that point. You may have time-based conditions. So I use time-based conditions, where if I'm trading a particular session, so if it's London or New York, and I'm trading a specific strategy that I've got, rules-based strategy that is specific to those sessions, then if I take a trade in New York, I want that trade to be closed before end of day in New York. I don't want to hold it beyond that, because of the rules that I'm using and the bias that I'm building that trading strategy around is only valid for that session. And my back testing has shown that once you exit that session and head towards the overnight session in Asia, we can quite often see price go the opposite way. So the edge that strategy has for me only applies to that session. So I'll look to close before the end of the session. So those kind of rules. And the best way I can think about this is, and it's not something I'm going to claim for myself, it's something I've seen somebody else mention, and I thought it was a really good analogy. I can't remember what it was, or I would credit it, but I've seen so many things over the years I can't remember where it came from. But I'll be upfront and say this is not mine. Is if you think about it like a 747, so the one pictured on the screen there. So once you're in the trade, you have, let's say, four. You may have 4, 5, 6, 3, whatever it is. But let's say in this scenario, 4 conditions that need to remain valid, or need to remain true for that trade to be valid. And if you start to see 1 or 2 or 3 of those invalidate, you may want to risk manage the position while you're in the position. So either exit a portion or move stop to break even, or exit the whole thing. And the way to think about those conditions are as those engines on the plane. So if you're on that plane and one of those engines goes, you might think that's fine. We can survive. We can land with 3 engines. If a second one goes, starting to get a bit ropier, maybe conditions are getting a bit worse. And if a third of those engines goes, or a third of your conditions is validated or invalidated in this scenario, you're probably not going to want to stay on that plane. If you had a parachute, you would jump out at that point when there was only one engine left, because it's unlikely that plane's going to be able to land. So it's that kind of engine conditions analogy I thought was quite a good one for kind of putting it across. It's maybe a bit blunt, but I'm only talking about trading here, not actual planes, and no planes were harmed in the making of this video. But that's kind of how it works, and you can act as trade filters while you're in trade. So we talked a lot about trade filters and rules for setting the trade up, for identifying the trade, and actually getting yourself in and taking risk in the market. But these can act as filters within the trade, so they're different to the rules that you would look for to actually get in. It's more what keeps that trade valid once you're in it. It's worth saying that you'll never get these 100% right, the same way as you'll never get any trade 100% right. So you might have scenarios where you exit a trade early and it then goes in your favour. You might have a trade where your conditions stay valid right until the trade stops you out. These things can happen, and you have to really test it and settle yourself in terms of how you want to go about this. And you might decide that your approach certainly early on is going to be just to go with your initial plan, and either you hit T1, take your whatever your partial is there, and then you manage the trade after that in terms of trailing stops and whatever, or your stop gets hit and you might want to leave it at that. But just to give you a few ideas that this is a perfectly valid scenario, and there are certain conditions that you could look for within your strategy. As I said, give 2 obvious kind of examples as the EMAs and the time-based strategy. There's so many more. There might be a certain, if it's in if it's a long trade and the trend is long, and on the lower time frames you've seen higher high, higher low, higher high, higher low, and you see that higher low violated, and it sets a lower low, that may be one of your conditions. So things like that, things that would be early signals of the trade starting to turn or go against you before it's hit your target. And the aim of these is very much to try and turn some of your losers into either small winners or smaller losers. Because as I said, over the series of trades, if you can be consistent in terms of your maximum loss, then your win rate only needs to be at a certain place in order to make money, in order to be profitable. If you can turn some of those losses into smaller losses or smaller wins rather than a loss, then again your equity curve is going to be going in the right direction over time, because you're removing some of the 1R losses while retaining all of your higher R gains, and that just helps in terms of the compounding of the account over time. So just the last wee thing to think about there, and hopefully that makes sense. I'm not going to dwell on that point too long. I think we'll bring the series to a close there. Hopefully it's been useful. Hopefully you've learned a little bit about certainly the way that I look at things. And as I said in the first video, this is only my view on it. It's only the way that I implement this. I'm not claiming that this is the only way to do it or it's the best way to do it. It's just a bit of insight into how I do it, and if there are things that you can take away for this series in order to help your own processes or refine your own processes, then great. But we'll call it a day there. Hopefully it's been useful. If you get any feedback, stick it in the comments or in social media or in the Discord. Any questions, as always, stick them in the comments to the video, or ping me on Twitter or Discord, and I'll try to get to those answers. As always, thanks for listening, and we'll speak soon. Until next time, stay safe. My tea's it. Gotta go.